Hello, welcome to Accounting Hub. I'm Professor George Scarpin, PhD in accounting. Our topic today is the gross profit method when we are working with inventory. And guys, subscribe our channel. You will be the first one to know when a new video arrives. And like our Facebook page, Accounting Hub by Dr. Scarpin. We always have some very nice stuffs over there. And what is this method? First of all, it is also known as gross margin method. Okay, and it's useful in situations where estimates of inventory are desirable. So here we are working with estimates of inventory. So it is not allowed for 10Ks in the US or financial statements at the end of fiscal year in US GAAP or IFRS. Okay, because there we need the physical uh, counting or physical amount of inventory. So, if it is not allowed for year financial statements, why do we do that? Because it's desirable in determining cost of inventory that has been lost, destroyed, or stolen, in estimating inventory and cost of goods sold for interim reports, for quarterly reports. It is allowed for quarterly reports, especially in the US. Avoiding the expense of a physical inventory count in auditors' testing of the overall reasonableness of inventory amounts reported by clients and budgeting and forecasting. So it is not for year-based financial statement, but it is quite useful. And what is the difference? Usual method. We start with beginning inventory from our previous financial statements, plus net purchase from our journal entries and so on. We have goods available for sale. Less in the inventory, we have the cost of goods sold. What is the gross profit method? Beginning inventory, the same. Net purchase, the same. Goods available for sale, the same. So here both are the same. However, less the estimated cost of goods sold, we find the estimated ending inventory. How does it work? Let's go to our Excel file with the other inventory write down method, NRV, LCM, and so on. So we have here a lot of nice stuffs. So beginning inventory from our record from previous balance, 1,750,000. Net purchase, 6.5 million. Goods available for sale, sum of both, 8 million and 1/4. Net sales, 8 million. Less, this is what we need. We need the estimated gross profit. What is the percentage? That is why it is also called the gross margin. 30%. So our estimated gross profit will be 8 million times 30%. It will be 2.4 million. And we have our basic formula. Gross profit is revenue less cost of goods sold. So if we have 8 million revenue, 2.4 gross profit, so 2.4 equal 8 million less cost of goods sold. So our formula for cost of goods sold will be revenue less gross profit. So 8 million less 8 million less 2.4 million dollars. So our cost of goods sold will be 5.6 million. And then any inventory, beginning inventory here plus purchase here. That is goods available for sale. Less cost of goods sold here. So our and the inventory will be 8 million and 1/4 less 5.6 million dollars. So it will be $2,650,000. And we find our ending inventory here, our estimated ending inventory. Okay, guys, that's it. Quite easy topic today. So thank you so much. If you have questions or comments, just leave it here or email me at jscarping@gmail.com. Have a nice day and God bless you.